welcome to the first edition of Insights for 2016. Well, markets have gotten off to a very rocky start during January and February, so the question really is, what's causing it? Is there something to be concerned about, or is it going to pass? A couple of things to consider. The main problem seems to be a fear that we're going to have another global financial crisis. My view on that is there's no basis for people to have that thought. The main thing that's of concern, funnily enough, has to do with oil prices, and I look at it in this way. When oil prices go down, global growth should go up. A $30 reduction in oil prices should add about 0.5% GDP globally, and with the reduction we've had from over $100, that means that global growth should be 1 to 1.5% higher than it would have been a couple of years ago. Because lower oil prices simply move the profit from the oil producing companies and countries to those countries that actually use a lot of oil. So the cost of production becomes cheaper. Lower oil is good. The thing that people are concerned about is how quickly oil prices have come down. And that's having two effects on markets. Firstly, the confidence issue that sits around what happens to those countries who are significant oil exporters. Will they still be able to pay their debts? So the macro issue that we're looking at is something along the lines of, do we have a global bond crisis or a sovereign wealth crisis that comes out of lower oil prices? That is the key issue to watch. And particularly whether countries like Russia, who are large producers who are really feeling the impact of lower prices, may get pushed into some problems with either the repayments of their bonds or just keeping up with interest rates. The less substantive issue, because it is going to pass, we need to cast our minds back to the GFC. When the GFC hit, the countries, the sovereign wealth funds that put a lot of money into buying stocks, particularly global banks, were actually from the oil producing economies. If we think back to Citigroup, the UAE was a substantial investor in different forms in actually picking up its stock and supporting that company. As we go through lower revenue for those oil producing companies, even though we don't see it in detail, realistically they're probably reducing their other investments. That means a lot of capital is coming out of listed stock markets and other areas and going back to those countries so that their economies can function as they did previously. So they're the two issues to watch for me. Something out of the blue, such as for a small oil producing country having a bond default or a problem, and that's the legitimate area of concern. And then secondly, just the movement of capital to go back to those economies that need to redeploy it because their revenue is now only about 25 or 30% of what it was. Otherwise, the outlook is pretty solid. Participation rates in the US and here are good. Inflation in the US is picking up. Australia still has a little way to go. Company profits are reasonable. So everywhere I look, I think it's fair to say things look pretty sound. The chance of that external shock, one of those macro issues playing out, I think is actually quite small. And once everyone gets comfortable with that, I think we'll see markets pick up in the year ahead.